All right, guys, I'm back for another week. Again, let me give you the preliminaries. One, I want to thank you for coming to CFS Studios. Don't forget to like, subscribe, and follow us. If you get anything useful out of this, please let us know by dropping a line in the comment section. Don't forget, you can ask me a question if you want to know. Today, I'm going to talk about my watch list, how I done. This all started back on February the 1st. I picked a few stocks that I was looking at and kind of did my due diligence with. So one of the things I would tell you is this: always do your own research, even though I may give you some information that you may find favorable. Again, I'm managing my own money. When I'm doing this show and have this privilege, my goal is to allow you to have a different point of view, but it's really not for you to say, well, I'm gonna do what he's doing. No, I wouldn't suggest you do that. Always say we have to be fiscal responsible. As you know, I waited to after the Feds did they talk today, so I got some points I want to address on that. But regarding my watch list, let me go back. I started my watch list back on February the 1st of 2023. I actually picked four stocks at that time, and one was Norwegian Cruise Line. The stock symbol is NGCL. NCLH. I don't know why I said so. NCLH. That's what I picked. At the time, the stock was trading for $15.35, and that was on February the 1st. As of today, it's at $12.51, and I actually priced it. If you go look at the bottom of the screen into the body of the section, I priced it to go as low as $11.30. So with Norwegian Cruise Line, if I would have entered on that day, or I would have waited to now, it's priced now at $12.54. My expectation, the lowest it probably would go before it bounced back was $11.30. If I look at another one that I put on February 1st, that was CCP. That's Carnival Cruises. I picked the cruise line because of this. Right now, as you know, cruises itself, that sector is leisure. So that's the leisure sector. One of the things that Chairman Powell stated today, and again, this is my opinion about what Powell was stating, is that even though they have been working behind the scenes and doing different programs to make sure that everyone who has a basic checking and savings, it's totally different if you have a broker's account. But if you have at a local bank, you have a checking and savings, they put themselves in a position to make sure that whoever has money at a local bank, they will be able to be fully paid up to 250. But if you have a small business, you have your money there, they'll make sure you get paid too. So the Feds right now is not letting any additional banks fail. With 36 banks, and he mentioned that 6 of them are in a position that regulators can go in right now and just shut those down. However, he did answer the reporter's question regarding that. Is he aware? He said, yes, I believe it's 6. At first, I don't know what he's talking. I'm not particularly aware, but then he ended up saying, yeah, I am aware. Six banks, 6 regional and local banks are at the jeopardy. However, they're going with a program to make sure that depositors know that the Feds are there, and they have other programs working that the U.S. tax people are not going to have to bail it out, but they have another program in place to do so. How come that's critical and that's important? Well, that kind of lets you know that brokers' accounts are looked a little differently at the regular bank accounts. The ones that's protected by the SPIC, they actually go up to $100,000 in cash or 400,000 in assets. So you're thinking like, what about my broker's account? I have, 300,000, you're protected. I have 400,000, you're protected. I have 500,000, you're protected. Cash up to 100,000, 400,000 in the equities that you have. That kind of give you a little backdrop in that. One of the other stocks that I had chosen to select after doing my due diligence was Copine, which is CPNG. That stock on February 1st, when I first looked at it, was $16.25. As of today, it's traded down to $14.23. I had it at a low around $11.85. So that was on February 1st. And then we had Roblox. And I say we, but really me. I had Roblox at $38.31 on February the 1st. And if I would have took the position, took my own advice, I'm looking at today was trading at $42.99. I had it at a high of $44.81. Now, that $44.81 was based on the current situations. The Feds continue to increase rates. And if they do, what are the consequences of them to continue to increase rates? The reality is that the Feds did hike rates again today, which we seen a rally on Monday. We saw a little bump, a little bit concerned what they're going to do. They were hoping that Feds would say we're not going to do anything, but that's not what they said. Fed said we're going to Fed. Chairman Powell made a statement, and in his statement, he made it, and he has the right to do so because he has to make these decisions. Well, in the process of that, he stated that he was raising rates and that they are going to continue to fight inflation as hard as they can. Now, let me just tell you something that I think is interesting before I go into the last two. What I think is interesting is if you go back and if you are someone who's going to spend your life investing your own money, not having someone else manage it for you, then it is critical that you take the opportunity to really learn how to have longevity in market. Because what a lot of things that's going on right now are really not just if you just take inflation, but from my perspective, it's not necessarily just inflation, it's actually regulation. For example, the input market commodities, which means their unfinished goods are being hiked up. Technology, and that means again the commodity market. But one of the things that's in commodity market is actually hospitalization. So hospitals and then pharmaceutical drugs, their prices recently, right there on you had Moderna right there in Capitol Hill. What are they doing? They're actually going and asking if they can increase their rate. I mean, they got rich, but they're asking Congress right now can increase their rates. You got Bernie Sanders and Elizabeth Warren. They're arguing the point, and it's a great soundbite from Bernie Sanders basically stating you made millions and now you want to hike rates, and the government is the one that gave you the money and you're asking it to increase it. And they were like, well, we got some systematic risk. We're really not sure. It's going from us having exclusive rights to the generic drugs not going to be able to make the same thing. And we want to be able to make our same margins, to make a long story short. But it's a great quote. You go back, you check it out, you listen to what he said. And the reason why I made that statement, because here's something to know. Investors are their own worst enemies. In a market like this, where volatility is all over the place, you can't predict the market. You're not going to get a phone call from any company you invest in. Again, you're not going to get that phone call from any company you invest in on the public market as a retail trader, even as an institutional trader. You're not going to get a phone call. What you will get is delayed information, because see, markets look forward and results look backwards. So it's always trailing. If the market looks forward and results look backwards, here's some things you need to understand. I'm gonna give you some information that can help you out so you can actually see this. Okay. One, over the past 20 years, the average investor earned 2.5% on a portfolio of 60-40 split. Now, if you're somebody who actually have treasuries and then you also have common stock, the average earnings on a 60-40 split above inflation was 6.1%. Now, I'm going to tell you where the information is coming from. I'll make sure I put that in there so you know where it's coming from. So if you're a person and you have common stocks, if you're a person who went out there and you have treasury notes, you have bonds, right? Even if they junk bonds, corporate bonds, on a 60-40 split, which means you had 60% of your money in common stock, 40% of your money, or you paid a hedge fund or you paid a financial advisor to do this the same. Split my money up 60-40. Oh, you earn 2.5%. And as far as inflation, the annual return over that time, over the past 20 years, if you average 20 whole years, your average over 20 years is 6.1%. Now, the longer you have, the more data you get as well. That's number one thing to remember. Number two is the average 60-40 investor has barely kept up with inflation at 2.1% during the same period. That's important to know. How come? Because humans overestimate their power to predict. Important to know. And here's something else about predictions and selling paper assets. You have to be glued to your screen to keep the market employed. Again, I'm gonna say that in. One of the things about buying and managing your money over your life, if you're gonna spend your life growing your wealth, then you need to understand that there are a lot of individuals that's around the market that have nothing to do with the stock that you're buying, want you glued to the screen to keep them self-employed. So here's something that I think that we should consider, okay? Chairman Powell stated today during his talk that he has no idea, he doesn't know. So if I don't know and you don't know where the market going, neither does the Feds. They don't know. They really don't. They're reacting the same way you are. So let me give you a hard truth to make you remember. Now, this is coming from JPM&M. This is a company that does research over 20 years. You can look them up. They do research. So if you want to get some good data, you can actually go to them and they actually do research. Some of the data you're going to have to pay for. Now, as you see me looking down, I'm actually at their website, but I want to just give you something for JPM&M because it's an interesting thing that they put out there. And then I'm going to go back and I'm going to, explain it. So it's JPM&M, their research company from 1980 to 2014. And what they actually do is they look at data 30 years or more together. So they got one running right now between 2015 to current, but it's not going to end to 2030. So when they ended at 2030, what they have currently said right now is that that research company, which is a good research company to look at, this is what they have stated, guys. They stated that nothing's changed. Now, what I'm about to read to you, they stated that nothing changed. Let me tell you what that is. So that way you get an idea and a concept. Because when you're going to manage your own money, I want to show you how 2020 proved that human beings make fundamental mistakes. Here's the first thing you need to know. It was the worst pandemic in modern history. We know that. 6.6 million people died. We understand that. Now, this is during the time, you understand, the market dropped. And this is what took place. Businesses were shuttered and employees had to work from home. That's a fact. We know this. Double-digit unemployment. And the return from February 19th of 2020 to March 23rd, which is, of 2020, the return in the market was negative 34%. That was the return, okay? So there was bad news. It was awful. It was horrible, and it was depressing, okay? Now, remember I told you human beings are horrible at predicting the market? The Feds don't know what's going on right now. They said they're going to continue to monitor the situation, which means they don't know. You're looking at saying when the best time for me to get in the market if you're not in the market. I never left the market. I'm still in the market. Because let me explain something that happened. 8 months later, in the year 2020, so we go from September to December of 2020, the market swung 52%. Nobody, the Feds, I sure didn't know this, and you didn't know this. It was a 52% return. Now, only a few people gained back. They got 18.4% who jumped in the middle of that market rising. Now, remember what I said earlier, markets are always forward-looking, which means it's already priced in. Some of the issues are priced in because you have to recall, at a company where I work at, the earnings come out every 90 days. So we're already forward-looking because we already got the news. We know what took place. We know what took place 6 months ago. We know what took place 90 days ago. We know what took place in this quarter. However, if we were in a situation where I was a CEO of a public traded company called Live on YouTube, you guys wouldn't know until the earning call of the end of the first quarter, sometime in April or May, you will find out about that data. But I knew from January, I knew from February, and I knew from March. Keep that in mind. One of the other interesting things is about the market is the opposite of the weatherman. Now, when I say that, I want you to understand this. A 5-day forecast accurate prediction on the weather is 90% accurate only 50% of the time. 7-day forecast is 80% accurate 50% of the time. And a 10-day forecast is 50% accurate 50% of the time. So that means no matter what you do, just cut it in half. Now, here's one thing you need to know. The market returns are positive 74% of the time on an annual basis. It's positive on an annual basis. 87.5% over a 5-year period, the market is actually good. 94% or over is on 10 years. And then if it's over 15 years, 100% of the time, the market is actually positive. What is that telling you? Well, that's telling you that you have two choices. And this is something that I think a lot of times, as I'm doing my research, I'm looking at a company, some people don't account for this. You have two choices. When I first started managing my own money and then trading my own money in my personal life, one of the things that I had to look at was, one, the companies that I was invested in, two, their earnings, three, I had to accept that I'm never getting a phone call. So when they make a decision, I'm not going to know. Four, I also had to accept this fact. I had to accept that if I invested in more than one company, more than one, and as I was investing in more than one, the CEO of the company, and I'm not referring to Elon Musk for all you out there who want to ask that question, well, what about Elon Musk? Okay, but I'm not using him as a reference point. I'm not using Warren Buffett either. And I'm not going to use, I'm not going to also use Microsoft founder, Bill Gates. I'm not going to use him. But I'm going to tell you, you got two choices. if you're going to go into the market, the reason that most people do get a financial advisor or they have a hedge fund manage their money is because emotionally, the market is unpredictable and humans are horrible at doing that. And they also are pessimistic. Now, I'm going to tell you why people are pessimistic. Because if you know this is going to help you make sure that when you're doing anything, when it comes to the market, that you're going to ignore everybody else. It's going to be you, the company that you invest in, or you in the index you're going to buy. If you buy the S&P 500 or an index fund. Now, Warren Buffett made a famous bet where he bet individuals that they were better off buying an index than investing with a financial advisor or a placement agent. When he done that, it was a 10-year bet. He won, and he showed that financial advisors and placement agents cannot beat an index. Now, and that's one thing just because of the fees. Just the fees in general, year over year, is a paycheck to the individuals who are managing that money. But I want you to understand something, the reason that people don't do well, because this is what pessimism is. And if you're going to be in a market, you have to have a high conviction that every day that I stay in the market, I'm learning more about myself, interacting with the market forces that have nothing to do with the company I invested in. I'm going to say that again. If you're going to trade your own money at all, you have to accept every day you're going to get better. That the market forces, that means CNBC, MSN, Fox Business, anything they're going to talk about media, you're going to say to yourself, I'm ignoring all of that. Because those individuals get paid to keep you mentally stressed out. So they put that information out there for a reason. But the only information you need is what the CEO is going to have a conversation, the chairman of the board, and that company is going to do for you. So here is the reason that people do bad in the market. Because they're pessimistic. How come? Pessimism is more common than optimism. Number two, it sounds smarter. When somebody's pessimistic, they sound really intelligent to themselves and anyone else who has a fear complex. Not that every day I'm in the market or if I'm using my own money and I'm at year one, I expect to go in and learn how I react to market forces that have nothing to do. And that means any media content, any print content, as I'm getting my bearings to scale into this company that I found that I believe is right. You're saying that. Number three, because pessimism protects you. If you're going to trade, don't be pessimistic, because that's actually a fear base. You ever met somebody who, when they get upset, they get angry? Anger is their defense mechanism because they don't have any other skill. So they treat you bad because they get angry. Their anger shows you that they don't know what to do. They like the feds. They don't know. So they use anger. They don't talk to you. They give you the sound. They pay verbal freeze tag. If you find, that means that person, whatever that event was, it triggered a response to retreat. So they use anger. Okay. You can't use that in the market because you can't retreat. You have to say, listen, I invest in this company. And I'm going to tell you something. Number four is it sounds prudent. Being pessimistic sounds prudent. Guys, you need to understand that being pessimistic doesn't sound prudent. It exposes the fact that you are new in the market. Number five, it's captivating. You can scare more people being pessimistic and become the most number one person in the room. How come? Because everybody wants to know. If a fearful person wants to know anything you have to say, they don't want to know optimism. You know why? Because optimism is very, first of all, being someone who's optimistic is very rare. Because people who are pessimistic say they're unrealistic, and mostly they say they're oblivious to risk. But the truth be told is a person that's optimism, they actually will learn more about how they interact with the market forces, which is the feds. Capitulation risk is the feds. It's going to be the government. It's going to be the local government, the federal government, the newscast, the print material, any type of website that's putting any data out, any friend is talking about it. They're gonna you turn on the radio today, or you turn on any type of station, the market's going up. I don't think you should buy this company. See, these are opinions, but these opinions are not facts. How do we know that? Because when these companies were started, these CEOs started a long time. Some of them are new. They came out during the 2020 Great Recession. But for those ones that wasn't, you need to understand that when they came out, these CEOs had to learn certain skills to communicate with retail traders like yourself or myself, or institutional traders like yourself or myself. They had to figure that out. And in the process of figuring out, they had to learn to ignore all that. There's only one CEO I've ever known in modern day history, and that's Elon Musk. He argues. If you tell him something negative about his company, he'll argue back with you, get in trouble with the regulations. He'll get in trouble for that. How come that's important? Because when you're thinking about, or at least me, and my watch list, if you look at the body, again, if you this is your first time joining the channel and watching any of the what I talk about on Wednesday, I talk about my watch list. I talk about what I've done, the reason I picked the stock. Don't forget to like, ask a comment. Maybe there's some stock that you're saying, hey, I wonder what Primo put on his watch list. I'll do a review of the stock during that time from Wednesday to Wednesday, and then I'll make that decision whether or not do I want to carry my list or not. But every decision I base, if you've never seen our show, is based on what cash I have. If I'm going to buy a stock and the only cash I have available to me is $2,000, that means I'm not looking at a stock that's higher than $20 because 100 shares is $2,000. If the stock is $30 a share, then I can't buy it because I only have access to $2,000. And it says, well, if I want to buy the stock, would I buy one share? Would I buy 50? No. If I can't buy 100, I won't buy none at all because I'm 100%. I have a conviction 100% that I can work well with that CEO. Second thing I would tell you is this. Right now in the market, you have to accept two different points of views, okay? And this is even a reality I had to accept. I had to accept one, the market is going to continue to be very volatile. The market will continue to capitulate in certain stocks that I have selected to be on my watch list. Like I said, I had Norwegian Cruise Line. I have two cruise lines. I don't have Royal Caribbeans, but I actually have Norwegian Cruise Line and Carnival Cruises. Now you would say, well, how come you pick those? The reality is I have that cash available to me if I wanted to buy them. That's the reason that I picked them. And other reason is because the Feds doesn't want anybody going on vacation. The Feds have made a decision in their mind that leisure, real estate, that the technology, emerging markets that are doing anything with consumer discretionary spending, especially if they're going to continue to increase the interest rates as they did today. When the Fed decided to increase rates, which means is that any money you have sitting in your savings is losing value. I knew that. So I definitely don't want no money just sitting in my savings. Yes, I get it. You got to have a rainy day fund. But if you just have money sitting in your savings, you have to know that the Feds just raised rates, which means you're losing buying power. Yes, you still got $100. That's true. You got $100, but $100 doesn't buy $100 of good anymore. You know, that little small box of cereal, you even look at it. At one point, you probably remember when you go into Walmart, they had some cookies, 3 cookies in a bag, a little brown bag, and they were $1. Well, if you went in recently, I went in Walmart recently to get some paper towels. In the process of getting those paper towels, I noticed that those cookies are now $1.25. So there it is. If I have $1 in my wallet and I wanted to buy those 3 cookies, maybe the macadamia cookies at Walmart, I don't have enough money. I don't, because a dollar doesn't buy them anymore. My dollar's only worth 75 cents if I want the macadamia 3 cookies in Walmart. And that's the Walmart market brand. I can't get it. You need to understand every time they raise rates and you're a consumer, the Feds are destroying your savings. So having money in your checking account is a horrible idea. It is if it's now, let me just take that back. It's a horrible idea if you're using your checking account as a savings and you paid all your bills. It's horrible. If the money's in your savings account and it's just sitting there as child support for checking, which means if I don't do what I'm supposed to do and misappropriate funds, I'm going to call my baby daddy, which is my savings. Or if you're a male, I'm going to call my sugar mama, and my sugar mama is going to put money in my checking for me. Yeah, I would never suggest you use your savings for that. I'll never suggest you use your checking for that. Don't use those two. How come? Because what you're actually doing is you competing the process of really growing your wealth. Now, with that being said, you got to take the position in your own life to say, okay, I'm going to use the market to be able to make money. And when I use the market to be able to make money, I need to make sure that I stay in the game. So you have to be able to have a high conviction. You have to know that no matter what takes place, I'm not leaving the market. So the question may come in to be this then. For me, this is what it was. How do I stay in the market? Understand I got to deal with drawdown. And drawdown is if I pay $10 and the price is now $8. As I mentioned before, if I would have bought Norwegian Cruise Line back on February 1st, it was $15.35. And today is $12.54. So that means I got a capitulation issue. If I bought that stock, I'm now down literally over $1 a share. And if I bought 100 shares, My $1,500 is now is now $1,400. If I did that, I'm down $100. The question is, do I have another, do I have $1,254 to start doing dollar cost averaging? Do I have the money to do that? And if the answer is no, then what I recommend is you understand is that my issue before I even started the market was understanding how much money do I need to continue to invest every month so I could buy 100 shares, not one, not two, not 10 shares, but 100 shares at every purchase. How long does it take me if I'm going to buy? So when I'm thinking about buying a stock, and it's the Norwegian Cruise Line, it's Roblox, if it's DraftKings, it was Shopify. If I'm going to buy that, I need to ask myself, if I can only buy 100, then once I open up my broker's account and I buy 100, how long will it take for me to buy another 100 shares? 6 months? Okay. My first goal now is to build my watch list. My next goal is not to deploy my resources. How come it's not to deploy my resources? Because I do not have the ability to dollar cost average. Now, some people would disagree with me, but the reality is because I want the motivation. I had to train myself to have that motivation to actually take a position consistently. So once I got to the point, my first year was putting money in the broker's account. Putting money in my broker's account. It was not taking a position. It was seeing what companies. I purposely stayed out of the market the first year. Some people say, well, Primo, you didn't really do anything. You didn't help yourself out of any. You didn't give yourself any favors. Yes, I did. And I'm going to tell you what I learned. I learned that my first year in the market, I was not a good stock picker because I realized that market forces around me. I'm going to tell you one of the most dangerous things. I made a mistake, and I hope you never do it. The most dangerous mistake I made is I started listening what people were saying about stocks and started looking at how much money I had. One of the first mistakes I made was a person said, man, you should think about this stock. And I'll never forget it. It was Regeneron. And that's a pharmaceutical company. That stock at the time was trading over $100. So that meant that $100 bought one share. I wasn't wise. I didn't know any better. I entered the market. I was listening to what people were saying. I had a friend that had invested in Regeneron. And I was like, okay, I'm going to do that too. I can only buy 10 shares of Regeneron. That's it. Now, that lesson taught me something. First of all, I didn't have $10,000 to buy 100 shares. Two is, he had bought Regeneron, and 2 weeks later, he had bought Regeneron at $88. So when we had talked and we were sitting around his house, I didn't think at the time, I didn't ask him how long he'd been in, but he had it for $88. It was over $100 when I bought. And when I told him when Regeneron actually went down $10 on one day because of market forces, which really analysts was talking about it was overpriced. Sometimes if you're buying a stock, you'll see a notice where let's say HBC, let's just say that Wells Fargo, analysts come out and say that the stock is overpriced. And they say that the price now going to be trading. Regeneron is no longer going to be trading at 10. They priced it to be $91.20. When they did that, again, remember stocks, if you're going to be in a stock market always looks forward, which means things are priced in and the results are going backwards. So you got to know that just automatically. So when stocks, by the time you know that a stock is doing bad, which may be in your favor, because right now, if you are, for like me, I like to buy growing companies. I plan on being in the market to the day I die. Unless I'm banned from being in the market. I plan on being in the market with my own money to the day I'm dying. And I'm being banned by my wife, nobody else. She's like, that's it. You suck at this game. You're not using another dollar value to grow wealth in the market, which that doesn't happen. So I don't have to worry about that. But if it did, I'm banned from doing that. Since I'm going to do this the rest of my life, I need to understand when the market is working in my favor. Right now, for me, you don't see on my watch list any gas or oil. You don't see any hospital stocks. You don't see any pharmaceutical drugs. How come? Because with interest rates being high, those stocks would have had to be bought back in 2020 because those stocks are now at the height in 2023. And if I only have $3,000 or I have 10 grand, I can only buy, if I have $3,000, I can buy a $30 stock one time. If I have 10 grand, I could buy a $30 stock 3 times. If you want me to be honest with you, that's $9,000. Well, 300 shares for $9,000. That's a bit steep. When would the next time I have access to $10,000? when somebody give me money or I get into an accident and they total a car or something. Well, if that's the only way you're gonna get access to it, that price of $30 a share for me, if that's me, is too expensive. I can't afford to buy a $30 stock. I had to learn all that my first year. Nobody taught me any of that information. You know what people taught me? And this is something I want to tell you guys. You know what people taught me? Buy stocks that I tell you to buy that everybody else is buying. Let me just explain something to you. Let me tell you, the herd is not always right. The herd is paying people so they can get out. That's the thing people don't realize. The herd is paying. Think about doing 2020 when you had AMC Theater, you had GameStop. Everybody, the people who were there at $5 to $15 to even $20, love talking about this stock. Remember, it's going to the moon, dog emojis, everything else. Okay, we now seen Bitcoin crash, but it crashed at the height that people had their money in it. AMC Theater, look what the price is now. I'm not even going to do it. You go look it up yourself. Look up where GameStop was. GameStop just had something to come out, and they Foot Locker. But just look at where it is to where that's at the height. And remember, I told you people are horrible at predicting stuff. And the reason they do it because they think pessimism is being smarter. Let me just explain something to you. For me right now, when I'm looking at the market, I'm very thankful. The Feds basically are saying, well, here's the thing. I believe that we're going to continue to raise rates. So that means people, if they want to buy a house, it's going to cost them more. If the rates were low, they'll get more house, more space, more house, lower payments. They don't care about that. You're going to pay more for a house, you're going to get less space. That's a fact. Second, if you're going to buy a car, you're not going to get no dealer's cash or anything. You're going to get hit on sticker. That's what they're going to try to do. Used cars are still very close to new car prices, especially if they're within 3 years. Number three, they clearly told you, technology, they're going to make those prices go low. Here's another thing they said, okay? Other than technology, they're going to make those prices go low. Oh, wait a minute. They're going to make the prices of leisure go low. Now, I always ask people this question. During Bill Clinton, during Barack Obama, now doing Biden, okay, these are the presidents that during their administration, they increased the rates and you got less housing. Hospitals if you had any hospital stock, they rose. Okay, Reagan, Trump, and Bush, gas prices were low. During the presidents, like I said before, Bill Clinton, Barack Obama, and Biden, gas prices are high. So commodities are pushed up, other industries are pushed down. If Biden doesn't get reelected, then automatically, if it's a Republican president, unless the presidents, like what they're doing on the system changes, you most likely would see, if you in Exxon, Mobil, BP, any of those, you're gonna see those prices come down. How come? That's regulatory, guys. That got nothing to do with the stock market. That's regulatory. Regulatory, which means that is capitulation risk. So I'm looking at the market, I'm saying, interesting. During Clinton's administration, did I make bad choices? Did I see something different? During Barack Obama's Great Recession, did I miss an opportunity? During Biden's, what was I dead right during Biden's? Dead completely right. Now there was some hesitation and some holding back of some other things in my life that didn't allow me to maximize as much as I was. But I can tell you, 2020 and 2023, those realities are very set. How do we know? We know that's very set because the positioning and what the reality is. You have to remember that this market's going to swing. The administration is going to change. That's regulatory. That's capitulation risk. Here's another thing to realize. As the market plays out, are you ready for this? I'm ready for it, which means that you got to be in the market. The worst mistake I ever made was during the dot-com era. That was the worst mistake I ever made. .com. So we're talking about well over 23 years ago. What was the biggest mistake? Well, during the .com era, they personally attacked the technology industry. That's why a lot of them capitulated. Personally attacked it. Rates was a little high in 2000. I remember, doing it early before that, leading up to it from 1995 through 1998. You can get gas under $1, 88 cents a gallon. Okay, we know who was in office. Do the research. Gas prices are low. Oh, it's a Republican. Gas prices high. It's a Democrat. Now, the only way it changes if the person comes into office and they change their policies. But during the Republicans' time in office, one of the things I thought was interesting is that the feds would not raise rates. Barack Obama was president, they hiked them. We had a market crash. Biden's president, they hiked it. We got in a market crash. That's not a mistake. That's systematic capitulation. You got to learn that. You got to learn that there's a seesaw battle. And the question is, are you prepared to? And again, you can, let's assume that I use the representation that I just pick out of the stocks that I have, Norwegian Cruise Line, Carnival Cruise, Copen, Roblox. We talk about DraftKings and Shop. Let's choose, I decided to use Shop because I had DraftKings at $12.39 today. That was back on February 15th. Today, DraftKings is trading for $17.61. So if I would have took that, I could have made over $300 on one position just because on February 1st, when I did my due diligence, and then I had an exit. I said, I'm out of this at $19.77. How come? Because DraftKings is a technology. And you would say, well, how is DraftKings doing all of this? Because of March Madness. We just it's cycles too. Now you got cycles. You got to understand that in the market, you got cycles. What happens with DraftKings? What do they back their self up on? DraftKings, the competition for DraftKings, since I don't have it on my watch list, but I don't like to mention it, but DraftKings have competition. But what season we in? First of all, you got the NFL. Then you got March Madness. You don't think DraftKings is hiking up because they're getting access to more people gambling? That's one of the things you got to realize. That got nothing to do whether the company itself is doing good or bad. We're right now doing a cycle. Then you're gonna have boxing betting, baseball betting. There are certain peaks that are systematic that even no matter what the market is, you'll see these little spikes. And anybody who's shorting it, you get caught in that spike. And that's why you see that jump from $12.39 up to $17.61. The question is, does that $17.61 start to come down a slow drag? Because if it is, that's called the short squeeze. And most likely, again, we're in March Madness. People are gambling. You got this DraftKings happening right now. People are gambling. So that's a cycle. You got to understand that. So if I have DraftKings in, I know that you're going to have ebbs and flows. I'm in the long term. I start thinking to myself, okay, if I'm in DraftKings, when is going to be my exit? Well, doing playoffs. So I got the NFL playoffs. There could be a spike in that. But if it already capitulated all the way down, then NFL is not going to do it. But March Madness is for college. So college football and March Madness generates more revenue than doing the NFL playoffs. You got to know that. I noticed doing the due diligence that has been that way since these companies went public, that college games betting has generated a little bit more. Then boxing comes along. So what can we find happening? Then after that, there is a drop. You got that information you would have known because you would have spent time. I can say that in the past, DraftKings has made me money. I've made money on DraftKings. Personally, I've made money. I have seen what took place. And I also know when I got out of DraftKings. And DraftKings was at a lot of higher price. Thanks be to the good technology in Biden's administration and the regulation of the Fed increasing rates, DraftKings came right back in where I needed to be at before I can actually buy back in, because I'm never giving back the money that I made in DraftKings. I'm keeping all of that. And I'm only going to deploy maybe 10% of some of the profits I made to turn those profits into more money. But I would have to know that because I spent time and I would have to do my research. That's not draft picking, guys. That's spending time understanding how that market operates. If you don't know, if you can't, the reason that people have to go out there and get financial advisors or hedge funds And a lot of times hedge funds, that the reason people go into hedge funds, you literally have to have over $200,000 to even have to get involved in the hedge fund because of the cost of that, the cost of the fees that hedge fund pays. Hedge fund fees are higher. And just so you know, traditionally, here's something that you know. And again, I said it earlier. If you haven't been here, don't forget to like, subscribe, put a comment in. Put a comment in if you have any questions or concerns out there. But I tell you that I think it's important that you consider this notion, and that's this notion that JPM. Okay, this is the company that actually does the research. This is something you should know. JPMAM Research. They do strategically. They do research over periods of time, and when they do this over periods of time, you need to know that what their research is. You know what they stated? Since 1980, 70% of all hedge funds have lost clients' money. Again, hedge funds, 70% since 1980 have lost 70% of their clients' money, and they charge fees. That's hedge funds. We saw during 2000 hedge funds collapsing. That basically means any profit that they made, they're going through the process of unwinding and giving back the money. Market returns were 11.8% during that time, where hedge fund only made 7%. They did not outperform. So if you go from I won't mention anything about a financial advisor because you don't need my help to do that. They did worse. Since 1980, they did worse. So the best way to beat both of them is for you to emotionally. Now, if you don't emotionally can't go through the process, which I'm willing to go through, I hope you are as well. That's the whole purpose of my Wednesday show, is to tell you what I want to go through. I'm willing to go through what it takes in order for me to be able to make an informed decision and understand what it is about the company that I buy. I invested in a stock called Nancy. That stock is NANCY, and the last name is the same as mine. I got all my apples in that basket. If I attempt to cheat, that's called diversification. Boy, am I going to be in some deep trouble. Boy, is she going to do that. So people say, what do you mean? Well, when you think about the position to be in a company, you integrate, you don't diversify if you're managing your own money. Because if you diversify yourself out of it, you actually would minimize what your wealth would be during a time of systematic risk. You have systematic risk, and that systematic risk is built into how you look at it. But if you don't have the ability to continue to allocate funds, then my first year was getting in the habit of consistently allocating funds into the market and then writing down this. See, by me doing this, I actually taken you guys back over 20 years of me writing down, doing research on the company, learning who the chairman of the board is, the CEO. And as I did that, I looked at it over time and said, okay, I'm looking at these stocks. I'm learning about them. Let me see if I'm right. And I would take a sheet of paper and write it down. And I would make sure, is this CEO a talker? Or is this CEO quiet? How come that's important? Because if the CEO don't talk and fight back when all the media is negative, you also got to understand that also, remember, the natural thing people are pessimistic. Again, don't forget to like. If you're getting anything out of this content that I'm saying as far as on my stock Watchlist, that you can look at the body, don't forget to like. Every time you like, it allows the Google algorithm to see that the content that I put out on Wednesday night live stream is actually helpful, and other people's able to find it like you guys find it. So do me that favor. If you're getting any viable content on the way my mind works, please do me a favor, hit the like, subscribe button, because just so you know. Now, with that being said, I had to learn that if I'm going to do anything, I need to do it one, just one. Can I get very good at one? How come? Steve Jobs only had Apple. Once he went out of Apple and once he made all his money, then he went and got involved in Pixar. Now Steve Jobs is gone and we got Apple, we got Pixar, his computer company that his computer didn't even work that got him to get back into Apple. Well, let's look at this. Look at another person. Well, we know Bill Gates, all he had was one. That was Microsoft. After he made his money in Microsoft by putting all his energy into that one company, then you get something else. So when you look at companies and you look at some of these CEOs, they pour all their resources, founders put all their resources into one. But everybody else who doesn't grow companies like this, they put their resources across 10 and 12. So we have a pessimistic view with those saying, well, you can't put all your eggs in one basket. And if you do, you thin out your returns and you get minimum returns. Who wants to take $10,000? I'm just going to be honest with you and make 6.1% on 100 shares? Because it's at $10, that's $1,000. So I'm sorry. So 10,000 is 1,000 shares if it's $10, but it's $100. It's literally only 100 shares to get what? 6.1%? Is that the best that I can do? That's the best I can do if I give it to someone else. But if I'm giving it to me, that's too much money to use to make 6.1%. So that's what I wanted to share with you guys today, is that my watch list that's listed in the body that I started in February 1st. If you go back, you can look at the other videos, you'll notice that each week I kind of, other than 2 weeks when I got sick, I kind of go back and touch on that basis so that you actually understand. But today I want to give a little bit more in depth because the question was asked, how do you know certain things? Guys, become a historian of the company that you invest in. That's all I ask. That's what I am. I'm gonna be a historian. I'm gonna give firsthand accounts of any company that I invest in. But you need to do your research so you can get firsthand accounts. Here's another thing that I think that people make the fundamental mistake, but I do this. Do you know if you're gonna invest in a company, they do free tours? Get your behind on a plane before you drop $3,000 into a company and go take a tour. They literally will walk you through their business. They have days. You call the investor relation department. I've done it. They walk you straight through the place. You be walking past people in their cubicles. They're trying to figure out who you are. You the guy who only got $3,000 in your bank account and you didn't buy their stock yet. But in the process of you going through they walk you through the entire location. Apple does walkthroughs, call the investor relation. Microsoft does it. Well, we know Buffett does it because he allows you to come through and walk through any of his businesses. You can just see that. He's not going to take you, unless you're one of those big heavyweights, to his office. But the reality is he has an event every year and people come through and they see his stuff he has is all on display. They migrate into Nebraska, Omaha, Nebraska, book up all the hotels, don't do an event on his shareholders meeting because people coming from around the world. And what are they coming for? To see the stock that they own. If you're not going to go and sit in the annual meeting at the company that you buy, don't buy it. That was the first lesson I ever was told before I got into this by many people that I came across that I won't mention their name for the sake of their privacy. They told me if you're going to spend 10 grand into a company, put $100,000 in it, and the only thing you're going to do is not go there in person and eat their snacks of the company you own and get a free beverage and talk to the CEO face to face and sit in that room, then you really should have just buy it. I'm not a financial advisor. I'm gonna tell you that right now. I'm not a hedge fund manager. I'm not a financial advisor, and I don't even want to be one. I just want to be honest with you. I never want to be one of those guys. How come? Because I don't want to manage nobody's money. I want to manage my own. That's it. My own money, and that's it. I don't want to manage nobody else's money. Because that's the best way to be. That way people will make salaries off your money, but it won't be me making no salary off your money. I can tell you that. So I encourage you to watch our other live stream videos. Come back with me on Wednesday. Sit down. And I will do my due diligence to see if I find anything else. Drop a comment in the message. Let me know if there's anything else you want me to look at. I see there was a message, but I didn't catch it long enough. So it says message is redacted, so I won't even talk about that one. But, thank you for joining. I'm here every Wednesday. I'll see you in the evening. You can learn about it. If you missed any content I put earlier, watch the live stream again. It'll be up shortly. Thank you, guys. Thank you for all the likes. Thank you for being here and allowing me to tell you. And spend time with me to learn how I done it. And you'll get to find out what my results are, too. Until next time, you guys have a wonderful day. Check out our YouTube channel. Don't forget to like, subscribe, share this with your friends. Tell them every Thursday, Primo Galicia is every Wednesday, Primo Galicia is on the live stream. He's talking about, his stock watch list. And there may be even more. But as of right now, based on what I have, I actually have 6 stocks. And I'll see if I'm adding anything next week. Till next Wednesday, you guys have a powerful, wonderful day. Good night, everyone.